In 2008, the world was hit by one of the worst economic downturns in modern history. It was a recession that would shake the global economy to its core and leave millions of people struggling to make ends meet. The recession of 2008 was a global financial crisis that began in the United States and quickly spread to other countries. It was caused by a combination of factors, including the housing market crash, the collapse of major financial institutions, and a lack of regulation and oversight in the financial industry. As banks began to collapse and the stock market plummeted, the impact of the recession was felt across the globe. Businesses closed their doors, people lost their jobs, and homes were foreclosed on. The recession led to a significant increase in unemployment rates, with many people losing their jobs and struggling to find new ones. It also resulted in a housing crisis, with many homeowners unable to make their mortgage payments and facing foreclosure. For many, the recession was more than just an economic downturn. It was a personal crisis that would take years to recover from. The impact of the recession was felt most severely by those who were already struggling financially, including low-income households and people of color. Many people were forced to rely on food banks and other forms of assistance to make ends meet. The roots of the crisis can be traced back to the early 2000s when the housing market was booming, and banks were lending money to almost anyone who wanted to buy a home. This led to a rise in home prices and a surge in home construction, which fueled the economy. The housing market boom was fueled by risky lending practices, including subprime mortgages, which allowed people with poor credit to buy homes they couldn't afford. This led to a rise in home prices and a surge in home construction, which created jobs and boosted economic growth. But when the housing market started to cool off in 2006, many homeowners found themselves owing more on their mortgages than their homes were worth, and they began to default on their loans. When the housing market began to decline, many homeowners found themselves in a difficult situation. They were unable to sell their homes for the amount they owed on their mortgages, and they were unable to keep up with their mortgage payments. This led to a wave of foreclosures, which further weakened the housing market and the economy as a whole. By 2008, the crisis had escalated to the point where two of the largest investment banks, Lehman Brothers and Bear Stearns, had collapsed. This sent shockwaves through the financial system, and credit markets froze up, making it difficult for businesses and consumers to obtain loans. The collapse of Lehman Brothers and Bear Stearns was a turning point in the recession. It led to a loss of confidence in the financial system and a freeze in credit markets, which made it difficult for businesses and consumers to obtain loans. This further weakened the economy and contributed to the high levels of unemployment and foreclosures. The impact of the recession was felt far and wide, as unemployment rates soared, and people struggled to make ends meet. The recession had a significant impact on people's lives, with many losing their jobs, their homes, and their savings. This led to widespread protests and calls for government action to address the crisis.